Folks, I've said it before. I'll say it again, I'm sure, but I believe what we are about to enter is bigger than the crash of 2008, certainly in one part of the real estate sector. That is kind of what's generally called commercial. I think there is a lot of pain coming. I think there will be a lot more people impacted by what is coming. I think the total dollar value of lost dollars will be bigger than '08. So I see a lot of pain coming. Frankly, Jonathan and I have been warning this was coming, but it's here, and I think it only gets worse. Jonathan, how you doing?
I'm doing great, Michael. How are you? What a lovely topic to come back to after being in Japan for a week, to talk about financial devastation. But
Exactly. It's good. It's one thing I do feel good about is we were early and we warned people.
yeah,
But now that it's here, it's starting and it's going to get bad. I mean, we've heard about Brookfield walking away from Class A in LA. I don't know, 4 or 5 buildings in DC. We've heard Blackstone walk away. We've obviously heard about the apartments in Houston. Just more and more and more coming. There's something like $1.5 trillion in commercial debt that's due in the next 12 months. And yeah, there's going to be a lot more pain. I think this will be bigger than '08 for this part of the market, probably
yeah,
without question. And it might be bigger by several magnitudes. So what do you think?
yeah. I agree. I mean, I think that the the industry is really going to have a tough time in the next couple of years, and the reason for that is, you know, part of it is just the office debacle, right? I mean, office was always the kind of like big boy
Yeah, it was like the thing, right?
institutional. It
Yeah.
was, yeah, that was like the blue chip, status asset to invest in. If you're a Sam Zell, right, you're investing primarily in office, right? And the reason for that is because when you're dealing with big companies with good credit, right, trophy assets, it can't be replaced. They're not building, like cookie cutter offices over and over and over again. Like there was a whole lot of reasons why these assets were seen as being like just really, really safe to be in. And now because of COVID and work from home, I mean, it is going to be a bloodbath in that industry, right? And at the same time, you're going to be seeing something of a bloodbath in multifamily as well. And part of the reason why I think that this could be worse than 2008 for the property industry is because of office, right? Like you did not have that same kind of crash. I mean, this is an unusual crash. I think everybody really has to understand like how big this is, right? Like in the last crash, like office suffered for sure, but you weren't talking about like, you know, everybody just walking away from the asset because they can't service the debt, right? Things like or the idea that like office isn't coming back, right? This is kind of like a phase shift moment, right? On top of which you've got the normal sort of cyclical issues from debt, right, with multifamily. And
Yep.
so I think it's really going to be tough. And on top of that, if you think back to the crash of 2008, there was a pretty short period of time during which the bubble developed, right? It was really like after the stock market bubble crashed, right? The dot-com bubble burst, that the Fed dropped interest rates to zero, right? And it's the buildup happened over sort of 4 or 5 years, right? Where the property bubble really developed. This time we've had this long, long, long property bubble developing, right? So the property prices have had even more time to build up over time, right? And more people to get into the market thinking this is never going to end. This is look how long it's gone on. It can't possibly change. Oh, interest rates can never go up, right? You didn't ever hear anybody in 2006 saying interest rates can never go up. You never heard that because interest rates were always going up and down all the time, right? But this whole conversation about interest rates never going up because they can't go up because whatever, the federal budget deficit, or the federal government can't afford it, or all these kinds of things, right, that you heard people saying couldn't happen, that just lulled people into a false sense of security. And you had these, classically low cap rates and all this retail money flowing into these assets that you never had before because of the growth of syndication. All those factors combined to create a a bigger bubble than you would have seen otherwise, and then the reaction is going to be just as big,
Yeah.
equal amounts of reaction, right?
What's really obvious to me was, so I believed, and again, I took action. One thing I always do is I share with people what I'm doing. So heading into 2019, at least in my market, cap rates were record compressed. So I
Yeah,
sold a
yeah,
couple of my apartment buildings and got great numbers for them. And I think the bubble was already forming then. And then, of course, we had the pandemic, and cap rates
yeah,
almost got cut in half. So I left $500,000 or more on the table because of
sure.
that. But what happened in that environment is the bubble got bigger and the debt got worse. It's
Yeah,
always the debt that gets people. People went short
always the
term.
debt.
It's always the
Yeah,
debt. It went IO. It went. Then they started doing stupid things like crazy rent adjustments. Yeah, I know you had 12 months or 18 months of crazy, but why are you forecasting that? And then
yeah,
record occupancy. Now you're forecasting the assumptions and stupidity that I saw in term sheets was beyond comical.
yeah.
And I'm like, this is not going to end well. Why are people? Because I've been accredited for a decade. I see a lot of these deals, and the stuff that I saw in 2020 and 2021 was sickening. And it
Yeah.
only got worse the longer it went on. It was crazy.
Yeah, it was just a bizarre situation. I mean, if you think back to the great financial crisis. Now, again, the people that got hurt it was always debt that kills you, right? And at
It's
that
debt.
time, the problem was over leveraging, right? So the problem was people putting too much, going up to 85, 90, 93% leverage on properties. And at that time, everybody thought, well, this is fine because the market's going to keep on going up and you'll just
It
sell.
only goes up, Jonathan. It only
Yeah,
goes up.
right. So then after the crash, the banks were like, okay, well, we're not doing that anymore. We're capping you at 75% leverage. We need that 25% cushion. We're not letting you put mezz debt on anymore. But the whole mezz debt industry basically disappeared, right? At least for multifamily. And so they problem solved, right? Well, then of course, as the market went up and up and up, and especially after the pandemic hit and and the Fed dropped interest rates to nothing and people piled in even more, right? Then the only way to get deals done was to make crazy assumptions and take on even dumber debt. So the leverage, Michael, you and I were talking about this 3 years ago, even before the pandemic. The leverage took the form of interest only. It took the form of bridge debt that was interest only for the whole term, right, with a lower DSCR. It took the form of people putting preferred equity, that was the new mezz, into deals. So it wasn't technically debt, but it acts like debt in a lot of ways. And I think a lot of investors also didn't understand that operators are putting pref equity into deals to get the investor returns up in a low cap rate environment. So equity investors would be interested. But the problem was that those terms that they entered into with those pref equity, investors basically allowed them to wipe out the common equity, right?
Yeah.
If things went bad. And so it was adding more risk to the deal, but people didn't understand that was just really the same as far as they were concerned as putting more debt on the deal. And people were just there were a lot of operators out there who basically were living on fees, and this is one of the reasons why I got out, right, myself.
Yeah, I
because
remember.
I didn't want to live on a treadmill, right? My idea of investing was build a portfolio of cash flowing assets that will pay you later
Yeah,
on. But it became
exactly.
impossible to do that, right? Because of the high price of assets. The only way to make money was to buy, rehab, sell as fast as you could. So a lot of people in the business were essentially they were making money on upfront fees, acquisition fees, and then what they were going to get on the sale. And there was no cash flow in the middle. And they had to be on a treadmill, right? And so there are a lot of people out there who built these big marketing organizations, right? Dozens of employees who were basically involved in marketing. And now they had those mouths to feed, and they just had to feed that engine with new deals, right? And so, of course, they got more aggressive with their underwriting. They got more aggressive with their debt. They got more aggressive with their marketing, right? And it was all and it all fed the frenzy. And, here we are today.
Yeah. At the end of the day, it's really funny. One of the things that I think is going to be very interesting about this crisis, and this is more of a guess than a prediction, but I think actually office is so bad right now. A lot of that debt's going to stay with the lender because there are no buyers. So
Mhm.
they'll extend and pretend. I hear there's a saying survive to 25 now. But I think multifamily, as we learned with the Houston example, I think that stuff's going to get foreclosed on. They're going to basically say the operator's an idiot, inexperienced. We've got to close this. And LPs will lose everything. They'll take a small haircut. They'll give it off to a stronger provider. So I actually think multifamily paint's going to be worse than office only because office is so bad. There are
Right.
no buyers. It's kind of a weird time.
Yeah. I mean, I think that, the strong operators with deep pockets are going to benefit from this.
Absolutely.
And it's funny, like I keep on hearing people still to this day talking about the fact that like, well, multifamily is not going to fall that far because of all the dry powder on the
Mm.
sidelines, right? And this is just sort of a dumb argument
Yeah.
because first of all, the price is just math, right? I mean, if interest
Yes,
rates
math.
go up,
Yeah. Yes.
if interest rates go up, right, it just means on an underwriting basis, like you can't make a deal work just to cover your debt. So prices are going to fall. It has no, like, dry powder on the sidelines doesn't make any difference. But then the other thing that this whole like dry powder argument is completely like wishful thinking, because the dry powder is not out there waiting for a 10% discount, right? If that were true, they would already have jumped into the market.
Oh no, they're
They're
great.
waiting.
They're
They're waiting
yeah.
for that dry powder on the sidelines is waiting for deep, deep pennies on the
These are the
dollar type discount.
sharks. These are the
Yes,
sharks. They move once a decade and
right.
then they move heavy.
This is what they've been waiting for: is blood in the streets. And so
Yeah.
it's those players who, when the banks foreclose, they're going to turn around and say,
Yeah.
okay,
Little tap on the shoulder.
yeah,
Yep.
Mr. Hedge Fund with a couple billion in the bank, now let's do a
Yeah.
deal,
Yeah,
right?
you heard Blackstone just raised their largest real estate fund ever, 58, no, 42% bigger than the last one, $30 billion. You don't think they're ready to
Yeah,
get tapped on the shoulder?
they're
Hell,
not looking for 10% discounts, right? They're getting ready for 50 cents on the dollar, right?
yes,
For assets like the ones in Houston that just got foreclosed on, and many, many more to come. So
exactly.
that's where the dry powder is waiting for, and it's going to come into action. So, and look, the there's nothing ironic about it. Somebody posted this thing on Facebook this morning that kind of got my blood up, because they were saying, essentially some dude on TV was saying multifamily is just fine. I own 30,000 units and multifamily is just fine, but office and hotel and everything else,
I actually saw that interview. I thought that was
yeah,
crazy. I
they're
saw that
gonna
interview.
they're gonna be
Yeah.
sucking wind. And I was like, no, because and the argument was like, the demand for apartments is still strong. There's a lack of supply of housing. All those things are true, right? But none of that has anything to do with foreclosures, right? Because the foreclosures
Exactly.
are all about
If the deal's
the
bad, the
debt.
deal's
Yeah,
bad.
it's
Yeah.
all about the debt structure, right? It's all about when these deals come up to be refinanced and they can't refinance. It doesn't
Exactly.
matter that on an operating basis, the property is doing fine, right? Because if
Exactly.
you if the value has fallen by 30%, and now you've got to come up with additional capital just to get refinanced, and a lot of people will not be able to do that, then that's where the pain is going to come. So it's all about the debt, not about the operators. But
Totally agree.
a lot of these hedge funds out there are going, and private equity funds are going to pick up some non-distressed assets at distressed prices.
Oh yeah,
I
absolutely.
mean, they're going to do so well out of this.
Yeah.
So,
Well, Jonathan, do me a favor. Where can people find you? I just thought of topic number 3, so we'll get to that in a minute.
okay. Well, looking forward to whatever that is. But you can find me on Facebook in the Apartment Investors Club Facebook group, or you can go to apartmentinvestorsclub.com and grab my free download. And you can even listen to me, if you could stand to hear my voice anymore, on the Apartment Investors Club podcast on iTunes and all those other places.
Thank you, buddy. I appreciate you.